Welcome to the Compounders Podcast, where we explore the anatomy of public company wealth creation stories. On this show, we invite you to be a fly on the wall for the actual conversations professional investors have with public company CEOs. Through a series of interviews, we will learn about how to create a compounder, a sustainable company whose success builds upon itself, by hearing about the real-life experiences of public company leaders. I'm your host, Ben Claremont, a partner and portfolio manager at Cove Street Capital. In these conversations, I interview public company senior executives by posing the exact kind of questions I ask as part of Cove Street's diligence process. By talking to people who operate within a wide variety of industries, we will dig into the holistic aspects of company building that you are not going to hear anywhere else. Whether you are a professional investor, founder, or someone who is simply interested in business, we think this podcast has something for you.
All opinions expressed by your hosts and the podcast guests are solely their own opinion and do not reflect the opinion of Cove Street Capital or any affiliates. This podcast is for informational purposes only. It is not investment advice and should not be relied upon for any investment decisions. We are not recommending the purchase or sale of any securities. The hosts and guests may be beneficial owners of the securities discussed. You should not assume that the securities discussed are or will be profitable.
My guest on the show today is Weston Hicks, the CEO of Alleghany Corporation, a $9.3 billion market cap company that focuses primarily on the insurance and reinsurance industry. Weston became CEO all the way back in late 2004, and since then, the company has grown its book value significantly and, like a mini-Berkshire Hathaway, has built up an interesting portfolio of non-insurance businesses that includes everything from a machine tool company to a toy company. Weston was a key driver of the company's 2011 transformational merger with TransRe, a deal that established Alleghany as a global insurance powerhouse and has helped make it a Fortune 500 company. After close to 20 years with the company, Weston will be retiring at the end of this year, so I thought it would be a great opportunity to talk to Weston before he officially leaves the CEO seat and get his insights and perspectives on a variety of topics, including his thoughts on what makes a compounder, the benefits and the setbacks associated with the TransRe merger, how to compensate people and establish a competitive advantage within the insurance industry, and the emergence of ESG and how that impacts a company that underwrites catastrophe risks. Sometimes, when executives are on their way out, they're willing to be extra candid regarding their thoughts on their industry and on the world at large. This discussion will be no different. I think this is a great conversation for anyone who is interested in capital allocation, how CEOs help create an enduring culture, and what it takes to build a compounder in a very competitive industry. Before we start, just a few disclosures to note. First, Cove Street owns Alleghany stock. Second, Alleghany was formerly an investor in one of Cove Street's strategies. Third, Weston is a longtime friend of Cove Street's founder, Jeff Bronchick. And most importantly, all of the music was created and composed by our own Jeff Bronchick. Without any further ado, here's my conversation with Alleghany Corp CEO, Weston Hicks. I'd like to start the podcast at a pivotal moment in the company's history. So let's jump right in and set the stage. It's early 2011, and you've been CEO of Alleghany, a company focused on providing specialty property and casualty insurance since 2004. The world is finally thawing from the financial crisis. The stock was around 300 and book value was around 340 per share. So you're contemplating the merger with TransRe. I know it was 10 years ago, but I want to go back to that moment and talk a little bit about what you were thinking. So why was this the right time to engage in meaningful consolidation in your mind?
Well, Ben, we had been enjoying a number of years of strong underwriting results from our primary insurance company, which is a company called RSUI Group, which we'd acquired in 2003. And we had started to generate some excess capital. Because Alleghany doesn't pay a dividend, we consider ourselves really a capital manager. We found ourselves by that point in time with about $1.2 billion of corporate capital undeployed. And I think we had a market capitalization back then of, $3.5 billion or something like that. And so, we knew we wanted to have a broader, a more diversified base of operations besides one big specialty company. But it wasn't obvious what other segments of the industry we ought to be in. We knew that, some of the segments of the property casualty business were already well served by some very formidable competitors, large standard commercial insurers such as Travelers or Chubb, were very successful and getting more successful. The personal line side of the business was dominated by Geico and Progressive and Allstate. And around that time, an old friend of mine, Joe Brandon, essentially knocked on our door and said, I think TransRe might be for sale or might be available to be purchased. How would you like to be part of an investment group? The idea was we were going to form a group of investors that would capitalize a new company that would be located offshore in Bermuda and then acquire TransRe, and in that process, essentially move it offshore. And because we were going to be a minority investor we were going to be an investor in an offshore holding company, we couldn't own more than 24.9% of the company. So that was the original plan. And we were talking to some private equity firms. We were talking to other strategic investors. And then one day in the middle of it all, I was out. I remember the time I was out for a morning run, and just sort of the light bulb went off. There's no reason why we can't do this ourselves. And so we wound up deciding to acquire 100% of the company by not only utilizing that 1.2 billion of excess capital that we had, but also raising some additional capital by issuing equity in the merger. And the calculation that we made was that, the value that we were giving up by issuing our shares was no greater than the value we were getting buying TransRe at roughly 85% of book value. And so that's sort of how it all started.
And so that's great. It's a really interesting to get into the weeds and deals. Like, this is the thing as investors, until you read the proxy statement, when the deal's already announced, you don't learn anything about that. So that's interesting. So getting into why reinsurance, I get that it was kind of a diversification, but why in terms of like, what was that? Why was diversifying into reinsurance like a logical step and a good strategy move for you guys?
Well, it's interesting. Let's rewind the clock a little bit first. So when I joined Alleghany, my predecessor was a great investor in his own right, named John J. Burns Jr. And John was he's no longer with us, but he was a contemporary of Warren Buffett. His father was the first general counsel of the SEC and actually wrote the Security Act. And John was a former arbitrage analyst at Goldman Sachs before he became CEO of Alleghany. And, when John reached out and hired me, we had a discussion as, what would your plan be if you became CEO? And what I said was, well, my plan would be to, build a portfolio of great underwriting insurance companies, build up the asset base, and use the float to build competency not only as an investor in public securities, but use it to provide permanent capital and acquire other businesses that would enhance our overall returns. And he said, "Okay, that sounds good. Sounds like a Berkshire Hathaway. So why don't you go ahead and do it?" And so that was the original plan, but of course I had no idea how hard it is to actually do that. The hardest being first getting that platform. So when we saw that TransRe might be available, I knew TransRe well from my former life as a securities analyst. I knew it was a great reinsurer. I knew the people. I knew Mike Sapner, who was the CEO, and at the time, and I felt that this was a chance to get a great underwriting platform at a very reasonable price because it was out of favor and trading below book value. Everybody hated reinsurers back then.
Got it. That's really insightful.
So,
and
it wasn't a strategic addition to, it wasn't saying, we need to buy this to have our sister company be stronger. It was purely an opportunity to buy a great company at a reasonable price.
Got it. And was there I didn't get a chance to go back and look at the relative multiples, but was there a multiple arbitrage as well? If they're trading 85% of book, you guys were at 110 or something like that. So it's just immediately accretive, or was that not part of the premise?
Well, it was immediately accretive to our book value per share. And in fact, at the time we closed the acquisition in March of 2012, we had one of those rare events, which was a bargain purchase gain.
Nice.
Where we acquired the company at a price that was less than the accounting fair value of their net assets.
Got it.
I think it was over, I want to say around $600 million or so.
Got it.
At the time.
Yeah, that's an immediate gratification of a deal. That's great. So if you were to sit in our investment meetings, you would hear us talk about M&A almost like it's like trading baseball cards. You're like, this company should be bought and this company should be bought. Let's sandwich these two companies together. And my sense is that large mergers, especially in insurance, and especially when you're combining different cultures and operations in different geographies, it's really complicated. So maybe like to the degree that it's like at the tip of your tongue, like how difficult was that, cultural merger and, just putting the operations together relative to what you thought?
Well, I think it is very difficult when you have a business model to integrate the merged companies. Alleghany is different from most companies in except for, and I'll be first to say it's not an original idea, but the idea of being a holding company that operates really as a capital partner of its subsidiaries. So we don't actually run our operating businesses. So when it came to acquiring TransRe, it wasn't like we came in and fired a bunch of people afterwards. We didn't reduce the staff at all. The only thing that really changed is they had some people there that were involved in roles that were public company roles, and of course they were no longer a public company. So there was some change of responsibilities in that respect. And then the other thing that changed is we took responsibility for managing their assets, which is what we do. So, we decided who their outside managers were going to be. We started managing part of their capital base in an equity portfolio, which we do internally. And, we set risk parameters and we changed their compensation plans. But that was really about it. I think the big surprise about TransRe, just speaking from my perspective, was although we knew the senior management reasonably well, we didn't really know layers below that. And as we got to know the company, we were extremely pleasantly surprised by how broad the talent base was. 1, 2, 3, 4 levels down from the top. I mean, it is really a very, very strong culture at that company, and this is something it's hard to appreciate, from outside the industry. But when you're in a business where you don't really know if you're making money for 10 years, if you have people that are constantly turning over, you're just walking around in the dark as an underwriter. TransRe has kept everybody in their seat through a lot of adversity over 40 years. So they have a very, very strong sense of when is a risk priced properly, when does it make sense to write an account, when does it not make sense to write an account. Even when sometimes the market is saying everything's fine, they'll be saying no, we really have to non-renew that account. The price is not appropriate.
It's really interesting that you mentioned 10 years because if we fast forward to the present, you've owned TransRe for about a decade. And I went back and read the conference call and looked at the slides from that call that you guys did, and to get a sense of what you thought the opportunities were going to be. Maybe just, with that much hindsight, the 10 years of hindsight, I'd love to hear, where would you say the combination's been successful, and where has TransRe lived up to your expectations? And maybe where has, whether it's due to internal issues or maybe just, low interest rates and other things that are happening in the insurance industry, where has it maybe not been as successful as you'd originally hoped for?
Well, I think, first of all, overall, as we stand today, roughly today, we have earned about a 9% internal rate of return on the purchase price. So if you just unlevered, if you just say, what did you plunk down? What are the cash flows year by year? And then assume a terminal value at book value. It's about a 9% return, which I think is actually quite good, considering how low interest rates are in the first case. And secondly, the amount of money that's compounded. I mean, that's 9% compounding $3.5 billion, which is different from what the private equity industry does, where they say, okay, we're going to make a $100 million investment, but we're going to borrow it to begin with, so we don't start the clock on internal rate of return. And then, 2 weeks before we sell the company, we then pay back the loan and we claim we got a 25% IRR. That's a totally different exercise than what we do. The other thing is that 9%, I would say, represents probably 4 or 5 really, really profitable years, and then 4 or 5 relatively challenging years. The last 4 or 5 being the most challenging. It's no secret that the industry experienced some very extreme catastrophe loss activity over the last 3 years. And TransRe, although it performed relatively well, it had absolute underwriting losses from those events. In particular, typhoons in Japan and the 2018 windstorm season in North America. But as a result of those losses, the industry's capacity has started to retrench, and prices have gone up a lot, which is the way that it usually works. So we're quite optimistic that the next 4 or 5 years are going to be the profitable part of the cycle for them.
As a shareholder, those typhoons in Japan and some of the recent catastrophe losses have been painful for sure.
And of course, the pandemic. Let's not forget the pandemic, which cost us in total over $400 million. But I think that the major negatives from a strategic point of view about the business that I say we didn't fully appreciate is the incursion into the reinsurance industry of the capital markets. In particular, pension funds deciding that it's okay to write catastrophe risk for a 5% return. And in fact, they have the alternative capital market, as it's called, where an insurer will buy reinsurance protection not from a reinsurer, but essentially from a pension fund, using some techniques to transform that into a reinsurance contract. That has put a lot of pressure on the returns on the industry, and has clearly lowered the return on equity in property cat. Now, having said that, property cat is only about 15% of TransRe's overall business. The other factor is, we went through a casualty cycle, and the industry, I think, systematically underpriced casualty risk for about 5 years, and we're now seeing the reaction to that. Over that time period, though, TransRe, I would say, did what they can do, which is reduce the risk intensity of their portfolio. They moved business from heavy casualty toward more lines of reinsurance that have less volatility, lower margin, but lower downside as well, while they wait for the industry to come back. And, we're seeing that in lines like professional liability, umbrella, D&O, all those lines of insurance, and by inference, reinsurance are seeing significant price increases and significant improvement in terms and conditions.
I would certainly say, given the environment and COVID and low interest rates, a 9% internal rate of return on the deal is actually pretty strong compounding, given this, the size of the asset base you were working with. So, but when I think of a compounder, just from a almost like a Porter's Five Forces basis, you think of something that has a moat, that has a sustainable competitive advantage. For people who don't think of insurance as a like a technology, like a software company where you can see what the moat is and the competitive advantage, what do you think the sources of competitive advantage are in insurance, and how much of it, as you talked about, comes from culture?
Well, I think it's all culture, and the insurance industry, particularly commercial insurance and reinsurance, is a commodity business. I mean, when you're running one of these companies, you essentially on a daily basis have the decision. The market sets a price. You can either write the risk or not write the risk. And so the way to generate above average returns is right. And this sounds really kind of silly when you say it like this, but it's to write more business when the prices are attractive and less business when they're unattractive. The problem is all the incentives in the industry work to the opposite of that. When Wall Street in particular hates it when insurance companies shrink their top line. But sometimes that's the best thing you can do from a long-term point of view. So when I look at our two largest companies, which are TransRe and RSUI, in both cases, they have extremely strong cultures. They're great places to work. I think if you talk to most of their employees, they feel that they work for a company that really values them as underwriters, and or if they're in the back office, whatever the function might be. They keep people in their seats, and people spend a long time at each company. And that also is critical because, again, if you're a company that has new players every 2 or 3 years on the field, the team doesn't really know what it's doing. So I think we think hard about culture in all of our companies, and I think that is the main competitive advantage. The other way we reinforce that is we try to make large portion of the employees in those companies to be owners in their businesses. So in both RSUI and TransRe and Cap Specialty, our smaller insurer, each company has a phantom stock plan where key employees have an equity interest in the book value of the company. So with some performance triggers generally.
It's a perfect segue to my next question, and it's about compensation. So I think I was at a Berkshire meeting a few years ago, and Buffett, he always talks about in insurance, if you compensate people solely on revenue, what you get is a lot of new policies with poor underwriting. On the other hand, if you compensate people only based on profitability, no one takes any risks and you don't get any new policies. So, given that culture you're talking about, how do you balance that profitability versus growth tension at Alleghany? And what have you learned about compensation over your tenure?
Well, I've learned a lot about compensation, and I've learned it's extremely complicated and getting more complicated every day as shareholders and advisors of public shareholders, thinking proxy advisory firms in particular, are increasingly weighing in on what they want to see executive compensation look like. I think if you get people who really care about their craft, they don't need a lot of incentive to grow the business if they know that it makes sense to do it. I'll give you an example. RSUI likes to describe its business as a reactive strategy. In other words, they will react to the market conditions that exist. because their underwriters are paid for underwriting profits, if the underwriters see a market that's setting the wrong price, they'll say, that's just going to take money out of my pocket if I write that risk, even though I'll get a lot of premium. On the other hand, when they know that the market is moving toward them, which is kind of the environment we're in right now,
yeah,
they write a ton of business. Nobody tells them they have to grow. So it's setting that right growth incentive on an operating basis, so that, if you have the right people, they will be, they have the right link to incentives to grow when it makes sense. For the corporate staff, I think, you raised an interesting point, because when I joined Alleghany, which was in 2002, just to set the stage, John Burns in 1999 and 2000 essentially sold every operating business that Alleghany had. Alleghany had a reinsurer. It's called Underwriters Re. It was sold to Swiss Re. They had a growth stock manager that they sold to a Dutch bank that they bought for $35 million in 1995 and sold for $850 million in 2000, because we were in a bubble. And John saw that we were in a bubble, and he said, at this price, my shareholders are better off if I sell it than if I hang on to it. And so when I joined the company, we basically had $1.4 billion of equity capital. And if you looked at the parent company balance sheet, $1 billion of that was cash and a big position in Burlington Northern Santa Fe, which, a little trivia for you, John Burns, actually, being a transportation analyst, was and an arbitrage analyst, was really the creator of that railroad. He got the idea to have the Burlington Northern merge with the Santa Fe, and they merged. And then for many years, he was on the board of the merged companies until Berkshire Hathaway bought it and took it away from the public markets. So for many years, the culture of Alleghany was, well, sit around with a big pile of money and wait until, the markets hit a pothole, and then you'll be able to step in and buy really great companies cheap. And I was indoctrinated with that kind of philosophy. And the problem is, after 2008, as you know, we have an environment where anytime we get a dislocation, the central banks all jump in and make sure that everything stabilizes relatively quickly. So there hasn't really been the big dislocation since then. So we've had to pivot in terms of our acquisition strategy, and I can talk more about that when we get to Alleghany Capital. Great,
that's really interesting. And so you brought up the John Burns and that philosophy of kind of just waiting and being patient and having a culture that allows for inactivity. But I'm interested, and this is a question that we always we wonder about, and when you're sitting on our side of the table, is like, how involved is the board in all of that? And I guess it depends on the company, but I'd love to hear you talk a little bit about how you've interfaced with the board and work with the board when it comes to capital allocation and strategy creation, and like how influential has your board been during your tenure?
Well, it's been very influential, and to really understand it, you have to go back to the history of Alleghany. Alleghany was originally formed as a holding company for railroad interests of two railroad entrepreneurs, the Van Sweringen brothers. And in 1937, an investor group led by Alan Kirby, who was an heir to the Woolworths fortune, essentially got together with a guy named Robert Young and acquired what was then Alleghany in the public markets for, I don't know, $6 or $7 million, something like that. And that began in 1937, the history of the Kirby family having a controlling interest in the public stock. And in fact, when I joined the company in 2002, members of the Kirby family still owned, 25, 35%, something like that. I don't remember the exact numbers at this point, but it was a meaningful portion. So the culture of the company was always much like a family office, that it was although it was a public company, it was very clear as an employee that, you were managing the assets of the family. And when you do that, the first thing you have to make sure is that you don't lose a lot of money. The second thing is, you try to compound it and grow it over time. So Alan Kirby's son, Fred Kirby, was actually chairman of Alleghany when I joined the company. And then he retired after 25 years as a CEO, and then a number of years as chairman. And his son, Jeff Kirby, is our current chairman. Now, what's changed, though, with the TransRe merger, just to go back to the TransRe merger, we issued a lot of stock. And that was a very big decision for Alleghany, because it was reducing the ownership control of the Kirby family materially. But the board and the family thought it was a great transaction and was very supportive of doing it. So today, instead of having 25% plus or minus of the stock owned by a family, we have the family of BlackRock, Vanguard, and State Street, and they're now setting a new influence through the board on what we do, which is very different. Much of which I'm sure you read about, in terms of priorities under the banner of ESG.
So we always talk about CEOs and boards having a capital allocation North Star, some kind of shining light that helps them determine between investing in the business, doing M&A, buying back stock, paying dividends. And it sounds to me like, that the being part of that family was kind of the inoculation. And for you, would you say that you had some inklings of being a value investor beforehand, or was that?
Yeah.
Really...
Well, our business model has always been so far to have an investor as the CEO. So Robert Young, the first non-family CEO, was a guy who made a fortune shorting the stock market in 1929 and was considered to be, a great investor. Fred Kirby was a great investor. John Burns was an arbitrage analyst with Goldman Sachs under Gus Levy, if you know that name. And then I spent, a decade on Wall Street before I came into the job. So I would say the board takes the approach on capital allocation that the CEO's job is to make that decision, subject to review by the board and constraints, obviously, in terms of risk. And I would say when I look back at, my 17 years as CEO, it's very hard to make acquisitions, from your own investment experience. Not everything is a winner. I am pleased to say, though, that we as an organization, the biggest acquisitions, the two biggest, which are TransRe and RSUI, have both been very successful. RSUI is more like a 10, 11% IRR, and that was on $628 million initially. The ones that have not worked out have been relatively small. We made an acquisition in 2007, I believe, of a California workers' comp company. And workers' comp is a line of insurance that is particularly exposed to economic recessions. When you get recessions, you tend to see claims go up. And it's also a business that's very dependent on investment income. So we acquired it in 2007 and caught about 3 weeks of the end of the profitable part of the cycle. And then the financial crisis hit in 2008. And we lost a lot of money on that investment. So that was, I think, an example of where we didn't pay an unreasonable price, but we bought it at the wrong time. And then the other major loss that we had was our venture in oil recovery, which did not work out, really for two reasons. One is the collapse of the oil market itself, but secondarily, the technology that underpinned the investment didn't really work as hoped. But having said that, and I think our total experience in the energy industry is probably a net positive, because we made a lot of money on public equities in energy back in the middle part of the last decade.
I thought I would mention that the first thing Jeff Bronchick told me about insurance when I came to Cove Street was avoid two things. Avoid companies with Florida hurricane exposure and California workers' comp. Those are like the two things that are like in insurance. That's the best way to lose a lot of money. I think
I don't know if you're going to try to talk to Fairfax, but they acquired Zenith, and Zenith proves that there's an exception to every rule, right? I mean, Zenith has been enormously successful in California workers' comp.
No, that's fair. That's fair. So let's get to Alleghany Capital.
Sure.
Let's rewind the clock a little bit. So late 90s, you sell the operating businesses, and it's basically an insurance company. And then you merge with TransRe. Talk about what was the goal of setting up Alleghany Capital, and is it similar to what Berkshire's created? Like what was the model, and how if at all was your strategy different?
Well, we around when we acquired TransRe, we were trying to start to build something that would become Alleghany Capital. We initially started with some small, more early stage investments, trying to come up with something where we could leverage the knowledge that we had on different industries through the public equity work that we did, but trying to apply that to private transactions. And the beauty of the way everything kind of came together is because TransRe is very profitable. It has been very profitable over the years. It's provided us with a steady stream of dividends that has enabled us to fund the acquisitions in Alleghany Capital without stretching the balance sheet in any way, because we sort of are not a big believer in running a highly leveraged holding company. And along the way, we began to realize that there are a lot of great businesses out there run by family-owned companies, typically, where the family or the CEO is getting up in years and has their entire net worth and life invested in that company, and believe it or not, does not want to just sell it for the highest dollar to a private equity firm, because they care about the employees. Maybe they want to stay involved and in control to some degree. And so we zeroed in on a model, which is essentially what we say to these companies is, we will be your capital partner. There are certain things we have to do as a public company, financial controls, internal audit, ethics and compliance, things like that. But we want you to continue to run the business, and knowing that you have a $9 billion company behind you will enable you to think bigger about what you can do in your industry. So, here's the thing, Ben. Many private companies, they know they would like to buy out a competitor, or they know they'd like to start a new product line. But to do that, if you're a private company, it comes out of your own pocket. Yeah. Either that or you got to borrow a bunch of money, right? But there's no source of capital. Whereas they sell to us, and then they say, oh, well, wait a minute. Now we can buy the competitor across the street. You write the check, and I'll be diluted, and we'll be a stronger company. And so we have now 8 companies in the Alleghany Capital portfolio. Almost every one, except for the one we bought most recently, has made bolt-on acquisitions. strengthening their competitive position. They've made, major investments to improve their operations because we take a long-term approach. And we now have over $1 billion invested in Alleghany Capital, and it's generating somewhere in the 11, 12, 13% ROE range after tax. So, when I look back at my time at Alleghany, and I don't by any means take credit for this, we've had some very talented people who are the ones who deserve the credit. David Van Gazel in particular, and Udi Toledano, his partner, have been the ones that have really built Alleghany Capital. And now we have a team of investment professionals that run that group.
So I know you're not quite at the level of buying, Lubrizol or BNSF quite yet, but if you had to put your, kind of look into your crystal ball and over the next few years, would you say that you would, $1 of capital would maybe go into a big deal to build Alleghany Capital rather than maybe, adding on to the insurance side? How would you think about that?
Well, our experience when we get into larger companies, and we have looked at a few, is we're generally not competitive with, particularly if it's a public company, with, the buyer that is either strategic, who can actually bring synergies to the transaction, or a large private equity firm that's going to employ a lot of financial leverage, cheap financial leverage. And of course, as you know, if you're a public company and you're selling the company, the board has a duty to get the best price. So it's not like they can say, "Oh, we're going to sell to Alleghany just because they're nice guys." They can't do that. Now, I think where Berkshire's from where I sit, is in a unique position is some of these very large companies that he's bought. They were the only company around that could write a check that big. When push came to shove, there were no other buyers.
Got it. So
now the other thing I should mention, where we are different from Berkshire is, because of our regulatory structure, we're regulated by a number of states, but in particular, the state of New York. We are not allowed to take the assets of our insurance companies and invest them in operating businesses. Or I shouldn't say we're not allowed, but if we do, that capital will be disqualified. It won't count as regulatory capital. That is not true for Berkshire Hathaway. If you look at National Indemnity, you'll see one of their biggest assets is Burlington Northern Santa Fe.
Yeah.
So they have, credit to them, they seem to have a different set of rules.
In a lot of ways, I think the Buffett's enjoyed that. And so the title of this podcast is Compounders, and it's a funny concept because it's kind of something that investors put on a company. My guess is you don't have a poster on your wall saying, "I want to create a compounder." But I'm interested in like the idea of how you think about building shareholder wealth over a long period of time. Do you need to kind of lay it out there and be like, this is what we're doing, and have like this, they don't, maybe you don't use the word compounder, but you're kind of inoculating people in the idea of thinking long-term and being long-term? Or is this more of like a take it day-to-day approach where you set a strategy and you kind of, and you roll with it, as opposed to just like having some, overarching goal of what you want this to be in 5 or 10 years?
Well, again, I'm going to go back to John Burns, who was a remarkable executive and great with a turn of phrase as well. But when I was joining Alleghany, when it came time to talk about compensation, he said, "Well, Weston, let me tell you, there's nothing wrong with getting rich slowly." And that was sort of the culture of Alleghany. We don't have to make a ton of money tomorrow. We just have to not lose a ton of money tomorrow. And our orientation has always been, if we can hit, singles and doubles consistently, somebody who sticks around for a long period of time is going to do very, very well. Now, our particular goal has been to compound book value per share at between 7 and 10%. That goal, I would tell you, has become more and more difficult as interest rates have come down. Back when the risk-free rate was 4 or 5%, that was a different proposition from when it's 1.44, where it is today. But we still think we can do it because, in part, we now have $1 billion earning double-digit returns at Alleghany Capital, and we have 2 large companies that we think can grow their book value in that range. We link that to the compensation of the management team at Alleghany. So, the way that we're paid, we get annual grants of performance shares, which are basically restricted stock that vests if and only if book value per share grows at a certain minimum rate. Typically, we've set it for, I think right now, for me and for the executive team, if we grow at 7%, you get 100% of the shares. If we grow at 10%, you get 200% of the shares. And if we grow at 4%, you get 50% of the shares. And if it's less than 4, you get nothing. And we have had years where we get nothing. Now, that's measured over a 4-year period. And we have, so at any time, you have multiple tranches that are in process or in flight, as we say. And it really does focus you on keeping that consistent 7, 8, 9% growth. Obviously, if we could see an opportunity to do 15, we would. Of course. But the difference is, we're not looking to go out and financially engineer ourselves to a 13 or 14% return. Something else I'll mention here too, and maybe it's because the situation I inherited when I joined. I wouldn't wish rebuilding a company like I had to do on anybody. When I joined the company, we had no operating business. We had Cap Specialty, which was then called Capital Transamerica. We had 2 very small industrial companies, and we had a pile of cash. And it's, when you're trying to compete to acquire public companies or private companies, and you're not starting with with nothing in your hand, it's a really tough thing to do. So, we got lucky, frankly, with RSUI. I can tell you the story on that acquisition, which is a good one. So, we've had along the way plenty of indications from strategic investors who say we'd like to buy XYZ company for 2 times book, or, we could ring the bell on one of these. But the question we always ask ourselves is, well, A, what are we going to do with all the money? And B, how much are we have to pay in taxes? And once we go through those questions, it's a pretty high hurdle to actually sell something.
That's interesting. That's a great point. You brought up, your compensation structure, and I read your proxy statement every year, and I love it. It's a little complicated for some people, and I could see that, that some people might be turned off by having specific performance hurdles like that are based on, how the company does. I'm interested, like, have you seen a kind of self-selection in terms of the kind of people you can attract and hire? And maybe just in a broader conversation, like, what have you learned about retention and hiring over your almost 20 years at Alleghany?
Well, I think people in our team work at Alleghany because we offer reasonably attractive compensation. Obviously, you can make more somewhere else if you want to, but that's not why people come. They come because they get to practice their craft, and we leave them alone to do it. The analogy I always throw out there, which isn't a great one, but it's sort of like, you think of like the shoemaker who really loves to make a great shoe. We don't tell them how to make the shoe. We don't say you can't use the finest leather. We say your job is to make a great shoe. Now that can apply to, the chief accounting officer. It can apply to Alleghany Capital. So everybody is focused on doing what they do and doing it well, and having compensation that is directly linked to what you're actually doing, not what somebody in some other division is doing. And that goes for our operating businesses as well. TransRe is paid for TransRe's results. Each ACC company is paid for its own results, not Allegany's overall results. So for us, it's worked, I think. Now, I will tell you that, as we've gotten larger, we're now in the Fortune 500, believe it or not. We never think of ourselves as a Fortune 500 company. Compensation consultants are increasingly communicating to us, what proxy advisory firms think compensation should look like. And there are plenty of external parties that, have their opinions as to how management should be compensated. So, it's a constant discussion and engagement to try to reconcile those opinions with what we fundamentally think makes sense for us. To your point about absolute numbers, the reason why I've always liked absolute numbers set within the context of inflation and risk-free rates is it's not particularly relevant to me what the S&P 500 is doing. It's relevant when we think about managing our equity portfolio, but should we be concerned that we can't generate the same ROE that Apple does? 20-25% of the S&P 500 are these, mega companies now with oligopolistic business positions and proprietary technology and, incredibly powerful businesses. And that, we can look at that with envy, but there's not really a lot we can do to create it.
Got it. So no conversation with a public company CEO would be complete without talking about ESG. So yes. I wanted to talk a little bit about that. So let's just set the stage. We had once in a lifetime ice storm in Texas. It's 105 degrees in Vancouver. Clearly the weather has been pretty variable. And I grabbed a great quote from your 2020 letter that said, risk is endemic to our business. Our role is to price these risks properly so that markets have the right price for risk, not to eliminate them per se. So I'm just trying to get a sense of, insurance companies forever have been involved in underwriting risks of some kind of natural disasters and typhoons and storms. Right. I'm just trying to see, is this situation different for you and for Alleghany than maybe it was 5 years or 10 years ago? Like, how has that changed?
Well, there are always emerging risks, and both TransRe and RSUI are constantly looking at the tail, so to speak, of the risk distribution. I think what's challenging about the current environment is there seems to be a lot of confusion between the word weather and the word climate. And let's just remind everyone what climate is. Climate is the average of weather over 30, 40, 50 years. That is the climate. Southern California along the coast has a wonderful climate. That doesn't mean that on any particular day it's hot or cold. It's the average of its experience. I think what we've seen is obviously some extreme weather events. And we're always studying weather events as well as concentrations of exposure to try to make sure in the worst scenario that we can imagine, we can survive it. When you get to talking about climate risk, what we're really saying is based on what's happening in the globe from a CO2 and human-induced climate change point of view, what does that mean for future weather events? Not today, but 20 years from now, 30 years from now, 40 years from now. So all that's getting mixed up now in climate. So we have been, we've actually seen reports from some of the some of the rating firms that are now rating companies for ESG, and they criticize Alleghany, and I won't name them by names, but one in particular said, well, we give Alleghany, the equivalent of an F because they're exposed to hurricanes in North America. Well, I read that and say, I'm not sure how that helps anybody, frankly. Our job is not to avoid hurricane risk. Our job is to price it properly so that when somebody builds a building, they spend the money to make sure it can withstand an extreme weather event. And if we subsidize, poorly built buildings, then we just have buildings that fall over when there's a hurricane, which unfortunately, we're seeing the consequences of that right now. A building which, while we don't know why it fell down, it clearly, was not incented to maintain itself properly over long periods of time.
Got it. And so in that way, insurance can be a meaningful benefit to society because it allows people to, understand and price risk, but it also incentivizes people to think long term about their assets as they're constructing.
Right. It's the private markets pricing mechanism for climate risk. Now, there's another aspect of this, of course, which gets into the whole aspect of, what is your organization's role in producing carbon dioxide? And that's a separate question. That's not something we spend a lot of time worrying about as a white collar business that sits in offices or in their homes. We can certainly measure it, and we probably will at some point, since that's what external parties are asking for. But it's not a significant part of the issue there. We're not like an oil and gas company, although we used to be.
Yeah. So moving on to a totally different subject, but one of my favorite things about Alleghany, which I would say most Wall Street does not like, is the use of the special dividend. And a lot of companies, Wall Street people like myself, and not maybe like some like myself, like consistency. So they like, a 4% dividend yield, right? Something consistent, or they want you to buy back shares when you have excess capital. Right. But Alleghany's done it differently. And I'd love to hear a little bit about why special dividends and why do you think other people are so hesitant to offer special dividends when they have excess capital?
Well, I think there's certainly a school of thought that a consistent annual dividend supports the valuation of the company. And if you're running the company to get a higher stock price, that's the reason why companies continue to pay dividends that they're not earning. Yeah, because they're concerned that it'll cause their stock price to collapse if they cut the dividend. We've never run Alleghany with an explicit goal of improving the stock price relative to the fundamental value of the company. I've always been heavily influenced by Berkshire, like everyone else in the investment world, it seems. And, it seems to me that, as a manager of a public company, what you should be doing is trying to make sure your stock is efficiently and properly priced, not overvalued and not materially undervalued, because that means some investors getting burned on a transaction somewhere. So we focus on the fundamental value of Alleghany, and book value per share is a proxy for that for us. I would say that our return, our stockholder return over any long period of time is fairly tightly correlated with the growth rate in book value per share. Now, if we find ourselves in periods where we're accumulating significant excess capital and our stock price is above where we would want to buy it in size, we have two choices. We can sit on the cash. We have three choices. We can sit on the cash, we can invest it in other public equities, or we can return it to shareholders. And in a couple of instances, we we determined that our best option was returning it to shareholders. Although we have a lot of individual and taxable shareholders who now have, who have to pay a tax when that happens. I'm being one of them. So I remember when I got the dividend, I said, "Wow, this is great. I'm going to go out and, I'm going to go out and buy a new car." And then I said, "Oh, wait a minute. I got to give half of that to the government." In my case, because I live in New York City. So, we don't want to be in the habit of regularly declaring a lot of dividends. But I think if you find yourself in a position where you're accumulating as a public company significant excess capital that's earning less than your cost of capital, you're not really doing anybody a favor by just holding on to it forever.
That's totally fair. That makes sense.
So that's kind of the balancing act we've had. And we have to weigh that against, a constant inflow of potential acquisitions at Alleghany Capital. We never know if they're going to get to the finish line. We have a stock price which is changing. For a while there, we could buy it below book value. Then it got up above book value. By late last year, before the pandemic, we got up to $830, $840 a share. We didn't really want to be buying back stock at that price.
Sure.
It was, getting close to fair value there, we thought.
In talking about the stock price, so you've overseen a stock that, I think has unquestionably been a compounder. It was around 240 at the beginning of 2005 when you became CEO. It's around 700 today. And that's despite low interest rates, a pandemic, financial crisis, just a few things that were, threw some monkey wrenches into your plans. But as you look back over your tenure, what do you think the key elements of that success have been?
Well, I think it's been a lot of work by a lot of people throughout Alleghany, including not the least of which is the people who actually run the businesses. So I think we've had some tremendous performance initially from RSUI, later from TransRe. We've had, I would say, pretty good equity performance over the whole period. We've generated returns that have exceeded the S&P 500 by, in the range of 3 or 4% a year. So that's helped. On the other hand, a few foot faults have taken away returns. In particular, I mentioned Pacific Comp earlier, and our Employers Direct originally, and our oil investment. Those were negatives. I think when I look back at it, is when we've made big acquisitions, fortunately the biggest ones have worked out well. So being willing to step up when you see something that makes a lot of sense. I actually, although I became CEO at the end of 2004, I actually mark my own record back when I joined the company because by that point, John was really, he was 73, and he was basically saying, "Okay, your show now. Good luck. I'm here to help." And so RSUI was the first big acquisition, and that was July of 2003. We also started a company called Darwin Professional Underwriters, which to date is still our highest return investment. We started it as a managing agent using the balance sheet of Capital Transamerica, and then ultimately formed a company, took it public, and then ultimately sold it to Allied World. And that was over 20% IRR. So, that was a big success. RSUI has continued to compound at double-digit rates. And TransRe, overall, I think has been a big contributor as well. So it's all those things. And more recently now is really Alleghany Capital, which is just starting to hit its stride. This is a long-winded answer, but, I really do think part of my decision to retire at the end of this year is I wanted to leave the company in a position where, the year after I'm gone or the 2 years after I'm gone, it's producing really good results. And then it'll be Joe Brandon's problem to figure out what to do next.
And so that's a perfect segue to my question about what sustainable elements do you think have been built into the fabric of this company that make you very comfortable, stepping away and leaving it to Joe Brandon to screw it up?
Well, we have in addition to Joe, who I think is really is a great reinsurance executive and great insurance executive, and also, having learned at the seat of the master himself, a pretty good investor as well. I think Joe is the right person to lead Alleghany in the future. But beyond Joe, we have 3 or 4 people: Carrie Jacobs, our CFO; John Shannon, our Chief Investment Officer; David Van Gazel, our head of Alleghany Capital. They're all in their early 40s. They're all very talented people. I think they've been at Alleghany long enough to where they really have embraced the culture and the values of the company. And I think they will carry it forward along with the board and obviously Joe. I think, Alleghany Capital has really reached critical mass now where you mentioned earlier you're going to be talking to Markel. I mean, Markel got started on this well before we did. And I think, has done an outstanding job, obviously, of leveraging their investment expertise into acquiring other businesses. And so I'm pleased that we now have an organization there that has critical mass. We have 7 great companies. Some of them, I think, are worth a lot more than people can imagine if they really understood them. And, we can now enjoy their results as they continue to grow.
I should interject for listeners. Weston referenced the master himself. Joe Brandon worked for Berkshire. And so you were referring to his experiences with Buffett, is my guess.
Yeah, he worked directly for Warren Buffett for years.
Got it. So would you say that your legacy, as you look back, you'd like your legacy to be about culture and people, and maybe investment discipline? Would those be the kind of top 3 things that you want your people to remember about you?
And continued set Alleghany up for, in 2029, Alleghany will be 100 years old. I mean, it's an institution with enormous history, and it has managed to reinvent itself over and over and over again. I think leaving it in a condition where I think it's good for the next 10 or 15 years that's a good legacy.
For sure. And so I've got two last questions for you. This is one that I think I'm going to ask is, just about everybody, because I do think you learn a lot about, managing people and managing a business and operations and M&A. So what do you think are a critical thing that you've had to rethink or change your position on over the years? And anything that comes to mind that you've kind of had to do a 180 as you've gotten more experience?
Yeah, well, I think, if we look at Alleghany Capital, we started by making venture investments. They didn't work very well. And, we kind of learned we're not particularly advantaged here. It's a game that requires a lot of scale and diversification so that your big winners, your 10 baggers offset your investments that go to zero. And so we pivoted completely and we locked into a different approach, which was let's buy mature companies that are choosing to be affiliated with Alleghany for the right reason, which is they love their business and they need a capital transaction and they want a capital partner that's a supportive partner, but a relatively light touch. So that's one example. The investment function itself has been, equity management within Alleghany is, as you know, is a constantly changing game.
Yeah.
I think, there was a time where we made huge investments in oil and gas and made a lot of money from it. I think now you have to say, well, is that something you really want to do in this environment? And I think the answer is no. For the ESG objective, for example.
Got it.
So it's constantly changing, but obviously, it's critical to have a great team and building that team and making sure it's a place where other people have meaningful roles and enjoy what they do, and it is critical. It's not a one-person show.
Sure. And so let's move to the closing question that I'm going to ask all the guests. So I think I know the answer to this. I will interject that I think RSUI is an absolute gem of a business, and we love that business. But what would you say is the most misunderstood or underappreciated aspect of Alleghany? Like where do you think people need to give you more credit for where you've been successful?
Well, definitely RSUI. I think it's hard to appreciate really what a great franchise that is until you spend a lot of time in the wholesale specialty market, where essentially every company in that industry and most of the wholesalers look to RSUI as the class act in the industry. And they have an enormously great reputation, and they have produced phenomenal results and will continue to produce great results. I think the area that our investors understand least at this point is Alleghany Capital, and I don't fault them for that because we don't really help them all that much. We have 8 different platforms now that do everything from licensing creative content and toys to erecting buildings with structural steel fabrication to machine tools. We have a company in our machine tool group that makes diamond orifices for water jet cutting machines. That if you want to find a business that's a razor blade, razor handle business, that's one of them. And frankly, something like IPS, which is our engineering and construction management firm, which quietly, without a lot of fanfare, did all the heavy lifting for Pfizer and Moderna on building these vaccine factories that allowed us to have a chance against this pandemic. So we have some great companies in Alleghany Capital, and we're really proud of them. And I think if you look at how they're implicitly valued in the Alleghany family, I don't think they're recognized anywhere near their real value.
And I will point out that you guys just recently did an analyst day, that was focused on Alleghany Capital to help people to understand a little more.
Yeah, so we're going to try to do more and more of that over time. We recognize that's important. I will say, we don't, obviously we're required to disclose some financial information if individual companies in Alleghany Capital get to a certain size. But those companies, for competitive reasons and oftentimes for business reasons, would prefer not to have their financials out there for their largest customers to see.
For sure. Well, Weston, this has been incredible. What a wide-ranging discussion where we touched on a lot of topics in a pretty short period of time. So thank you so much for doing this. Congratulations on a really distinguished career.
Thank you.
And as shareholders,
it wasn't perfect, but and nobody is. But I've really enjoyed the last almost 2 decades at Alleghany, and it's a great company. And I'm sure my successor and his team will do great things.
Well, thanks again, and good luck with whatever it is you're going to be bothering your family with as when you go into retirement.
Right on.
Thank you.
Thanks, Ben.
Thank you. That's it for our show today. We hope you enjoyed the conversation. We recognize that you have a lot of different podcast choices, and we appreciate you spending the time with us. We are continually working to make the show better, and we would love your feedback. The more candid and honest, the better. And if you have any suggestions for public company CEOs you would like to see on the podcast, please let us know. And of course, warm intros are always appreciated. Please feel free to email us at podcast@covestreetcapital.com with your comments or suggestions. Thanks again, and stay tuned for the next episode of Compounders, Anatomy of a Multibagger.